If you're looking for consistent, dependable income from the stock market in 2025, you've probably noticed the volatility across tech and growth sectors. Stocks swing wildly on every tweet, interest rate update, or earnings surprise. Meanwhile, dividend stocks quietly tick along, paying you regardless of the noise. They're not about explosive returns, they're about reliable cash flow and long-term resilience. Today, I want to dive into 3 top-tier dividend stocks: Coca-Cola, Realty Income, and ExxonMobil. Each of them brings something different to the income table, but all share one thing in common. They pay you, even when the market doesn't cooperate. Let's start with Coca-Cola. You've probably had a Coke this week without giving it a second thought. That's how embedded this company is in daily life. But Coca-Cola isn't just about fizzy drinks. It's one of the most consistent dividend payers out there. Right now, Coca-Cola yields around 3.1%, and the real kicker is its track record. Over 60 consecutive years of dividend increases. Think about that for a second. Through recessions, tech bubbles, COVID shutdowns, geopolitical unrest, commodity spikes, Coca-Cola has never cut its dividend. That's virtually bulletproof income. The reason it can pull that off is simple: brand loyalty and pricing power. People pay a premium for Coke, even in tough times. But behind that sits a robust free cash flow operation, supply chain scale, and global distribution networks. The business model generates enormous cash that funds more than just dividends. They invest in marketing, innovation, like zero-sugar versions, and sustainability. You're not just buying a payout, you're investing in a brand with global scale. Yes, you're not going to 5-bagger returns here. But if you're building an income portfolio, Coca-Cola is the kind of foundation that lets you sleep easy. Dividends pay you every quarter. No need to sell. They add up over time, whether you reinvest them or use them as income. They smooth out market noise. Now, let's shift gears to Realty Income. If Coca-Cola is the foundation, think of Realty Income as the monthly fuel. This company has earned the nickname the Monthly Dividend Company for that exact reason. Instead of quarterly checks, Realty Income pays monthly. That alone is compelling, but the business is built on a rock-solid model. Over 13,000 commercial properties leased on long-term triple net leases. What does triple net mean? It means the tenant handles rent, insurance, property taxes, and maintenance. Realty Income becomes landlord, collects rent, and distributes it. Simple, predictable, resilient. They own everything from grocery stores and pharmacies to convenience stores and dollar stores. During recessions, people still buy essentials, and rent keeps coming in. The recent dividend yield is around 5.5%, a level that's solid for an investment-grade REIT. Historically, Realty Income has grown its dividend for over 25 years, adding almost every single year. That shows discipline and smart management. But it's not risk-free. Higher interest rates can pressure REITs, and if commercial real estate falters, rents and occupancy could take a hit. That's why you don't allocate everything here. But a diversified income portfolio can absolutely include Realty Income. Monthly cash flow is practical. You can reinvest it or spend it without needing to time your withdrawals. Finally, let's talk about ExxonMobil. This one is the wild card of the trio. Energy stocks have been polarizing lately. Climate concerns, ESG pressure, and volatility are all part of the conversation. But Exxon has pulled off an impressive transformation over the past few years. They reined in costs, cut debt, and reoriented towards shareholder payouts. Right now, they yield around 3.4%, which is sustainable and backed by roughly $30+ billion in annual free cash flow. Solid support. What's especially interesting is their pivot beyond just oil pipelines and refineries. Exxon is investing heavily in the energy transition, carbon capture, hydrogen projects, and even lithium mining. That's a bold move toward future-proofing. So with Exxon, you get the best of both worlds: a dependable payout from current operations and optional upside from green projects. Timing matters here. Energy is cyclical. When oil prices rise, Exxon's profits swell and dividends stay safe. When prices dip, there's risk. But Exxon's management is clearly focused on maintaining the dividend. They cut capex, boosted efficiency, and haven't wavered. So for a diversified dividend portfolio, Exxon builds a proxy for energy and inflation protection. Now, let's break down these companies, Coca-Cola, Realty Income, ExxonMobil, side by side, focusing on what makes them standout income plays. Coca-Cola is classic consumer staples. It's priced in everyday life. Your risk is consumption patterns and sugar regulation, but it's a low volatility business with enormous scale. These stable income stocks buffer you against sharp pullbacks. Realty Income is a bond alternative, REIT, with monthly distribution. It rides on staples, grocery, pharmacies. If consumer spending dips, rent may soften, but supply isn't flooding either, so occupancy remains solid. Add a yield above 5% and monthly payments. That's compelling for retirees, investors needing monthly cash, or anyone reinvesting regularly. ExxonMobil is a mix of cyclical energy and future optionality. The dividend is covered through best-in-class free cash flow, plus a transition plan. You get inflation hedge characteristics, oil tracks inflation, and exposure to energy sector upside. With the shift into carbon capture and hydrogen, you're also tapping the clean energy narrative. So what does this trio deliver in a balanced income portfolio? Think conservative yield plus sector diversification. Coca-Cola gives you stability. Realty Income gives monthly payout. ExxonMobil gives inflation protection. Boom, balanced structure with redundancy. For timing, these are not momentum trades, they're not ones you need to time perfectly, but there's nuance. Let's talk entry strategy. With Coca-Cola, dips below the 200-day moving average or value dips in consumer staples are fine entry triggers. Likewise, for Realty Income, investor concerns about rate cuts or temporary retail slowdowns might push the price down, but those are often good buying opportunities if underlying leases remain solid. For ExxonMobil, you watch oil's macro. Supply disruptions, geopolitical headlines, or even macro inflation triggers spikes. That's timing for entry or scaling in, but not essential. Here's a sample approach with $10,000. Allocate $3,000 to Coca-Cola, aiming to buy at dips, dollar cost average through any volatility. Allocate $3,500 to Realty Income. Knock out a quick monthly income stream while collecting yield. Allocate $3,500 to ExxonMobil, capturing yield plus inflation hedge and green optionality. Total yield mix: 3.1%, 5.5%, 3.4%. Weighted yield around 4.4%. That's pure cash flow, not counting reinvested capital or price return. Over time, compounded dividends build wealth, especially when combined across businesses and sectors. In terms of risks, Coca-Cola may slow if sugary drink demand drops or regulation tightens. Realty Income tied to rates, but 3-net model helps. Exxon tied to energy demand and shorter-term volatility, but dividend coverage is top tier. What about taxes? U.S. dividends are taxed differently based on your residence. Qualified dividend treatments or tax-efficient wrappers matter, so check your local rules, e.g. ETF versions, retirement accounts, capital gains versus income tax considerations. Here are a few quick takeaways. Coca-Cola, stability and decades of payout increases. Ideal for base-level income. Realty Income equals monthly income, attractive yield, commercial property-based. ExxonMobil equals inflation hedge, energy exposure, evolving into clean energy. If you want to build a broader set of dividend stocks, you can layer utilities, consumer staples, telecoms, or dividend ETFs, like Vanguard's VYM or Dividend Aristocrat ETFs. But these three give you core, monthly, and cyclical balances. Now, beyond just buying, what do you do next? Use a low-fee broker. Check links in description to BitGet, Scalable Capital, or eToro to set up a drip plan. Reinvest your dividends automatically or hold as cash for rebalancing. Track your positions over time. Monitor dividend payments. Coke pays quarterly, Realty Income pays monthly, Exxon pays quarterly. Review every 6 months for yield changes, dividend safety, and sector dynamics. Think about yield laddering. Add high-yield icons like utility stocks, MLPs, or bond proxies depending on your goals. Here's your script call to action. If you want help building out your dividend income portfolio, download my free spreadsheet linked below. It shows yield metrics, payout schedules, tax considerations, and entry price zones. Subscribe to capitalsuite for weekly income update episodes and market insights. And smash that like button because I'm covering undervalued dividend gems next week. Remember, the stock market is a generator of opportunities. Dividend stocks pay you to wait. Options fade, hype fades, but income doesn't. So stick with quality, stay patient, and let compounding work for you. Thanks for watching Capital.